Bitcoin feels calm, too calm. The early hodlers are stepping aside, selling their coins, and the giants of Wall Street are circling. Lyn Alden has said, Bitcoin's fixed supply and scarcity make it an attractive store of value unlike any other asset. While Michael Saylor warns that volatility is easing as early holders cash out, clearing the way for institutions to step in and build a stronger market base. Is this the launchpad for a bull run, or the trap before a drop? Bitcoin is in a strange but powerful moment right now. The market feels calm, almost too calm, but under the surface, a quiet transfer of power is happening. Michael Saylor recently said, volatility is easing as early holders cash out, clearing the way for institutions to step in and build a stronger market base. And that's exactly what we're seeing. OG hodlers who survived every crash are finally selling, while whales, ETFs, and corporate treasuries are quietly scooping up their coins. Lyn Alden calls this shift one of Bitcoin's most bullish signals, saying that every coin that moves from a weak hand to a strong one reduces future volatility and strengthens the network. This is classic accumulation phase behavior. Smart money buys when retail is bored, when Google searches are low, when the charts look flat. It's what happened before the run to $20,000 in 2017, before the rally to $69,000 in 2021. And history could be repeating itself right now. Michael Saylor, the man who turned his publicly traded company into a Bitcoin giant, just said something that might explain why this calm is happening. He said, volatility is easing as early holders cash out, clearing the way for institutions to step in and build a stronger market base. Think about that for a second. He's saying the wild roller coaster swings we've seen for years are starting to slow down because the old coins are finally moving, and new long-term investors are stepping up to replace them. But there's still risk. Regulation, macro pressure, and leveraged players like Saylor's own company could cause turbulence. If this is truly the base, though, this could be the last cheap entry before Bitcoin writes its next chapter. One that could take us well past $100,000. This is huge, because those early coins, mined on laptops and held through years of chaos, have been sitting like a time bomb. Every time Bitcoin pumps, some OG holders dump. It's human nature. They've seen Bitcoin go from a few dollars to tens of thousands. Cashing out can create short-term pain for the market. Sudden drops, cascading liquidations, panic selling. But once those coins have been sold and absorbed by committed investors or institutions, they stop being a threat. And it's not just Saylor talking about this. Lyn Alden, one of the most respected macro analysts in the space, recently said, Bitcoin's fixed supply and scarcity make it an attractive store of value unlike any other asset. Every coin that moves from a weak hand to a strong one reduces future volatility and strengthens the network. That's exactly what seems to be happening. Long-term holders are slowly handing over their coins, but not to panicked retail buyers, to whales, ETFs, corporate treasuries, and institutions. This is a silent transfer of power. Why this moment matters so much. This is not just a blip on the chart. This is what traders call an accumulation phase. Think about it like real estate. When the smart money starts quietly buying up land in a neighborhood, it's not because they're bored. It's because they know what's coming next. Cointelegraph reported that spot Bitcoin ETFs now hold over $138 billion worth of Bitcoin, and that number is still climbing. We're talking about hedge funds, pensions, family offices, serious players, getting exposure to Bitcoin in a regulated, safe way. That's the kind of money that doesn't just flip positions on a whim. That's sticky demand. The Merkle reported that over 41,000 BTC were quietly acquired by whales and institutions in recent months. And here's the kicker. This happened while retail sentiment was low, while crypto Twitter was bored, while Google search trends for Bitcoin were near multi-year lows. If you've been around long enough, you know what that means. Smart money buys when no one is paying attention. For traders, this could mean that support levels are about to get a lot stronger. It could mean fewer random 20% crashes that wreck everyone's stop losses. And for long-term investors, it could mean this is your window. The quiet before the storm where accumulation is safest. This has happened before. Look at the chart from 2015. Bitcoin spent almost a year moving sideways between $200 and $300. Everyone thought it was dead. Then it started its legendary run to $20,000. In 2019, after the brutal bear market of 2018, Bitcoin slowly built a base between $3,000 and $4,000. People called it boring, called it dead, called it a scam. Then it exploded to $14,000 in a matter of months. The pattern is clear. Bases are boring until they aren't. That boredom is part of the design. It's meant to make the impatient sell, to make the retail trader give up, so that when the breakout finally comes, the only people left are the ones ready to ride it. Risks and bearish scenarios. But let's not kid ourselves. There are real risks here. Jim Chanos, the legendary short seller, recently questioned Michael Saylor's company, saying its valuation is inflated compared to its actual Bitcoin holdings. He called some of Saylor's debt-funded purchases financial gibberish. If he's right, and if Bitcoin prices fall, leveraged players could be forced to sell, creating sharp downward pressure. Regulation is another wild card. A new tax rule, an SEC crackdown on exchanges, or a sudden ban in a major economy could spook institutional players and cause a temporary exodus. And let's not forget macroeconomics. If interest rates rise further, or if global liquidity dries up, risky assets like Bitcoin could take a hit. Opportunities and bullish scenarios. On the flip side, the opportunity here is massive. If this really is the base, this could be the last, best chance to accumulate before Bitcoin moves into its next phase. Imagine buying Bitcoin in the $3,000 to $4,000 range back in 2019. That's what this moment could look like in hindsight. If institutional buying continues, if ETFs keep seeing inflows, and if macro conditions turn favorable. For example, if central banks start cutting rates or inflation remains sticky, forcing investors to hedge. Bitcoin could blast through resistance and set new all-time highs. We could see $100,000, $150,000, maybe more over the next 12 to 24 months. Lyn Alden has said she expects Bitcoin to finish higher at the end of 2025, even though she's cautious about short-term volatility due to liquidity issues. Michael Saylor famously says, "Bitcoin is the exit strategy. There's no reason to sell the winner and buy the losers." His company has pledged not to sell, no matter what. That conviction alone is enough to inspire a generation of hodlers. Forbes reports that Saylor's playbook, buying Bitcoin with cash and even with debt, is now going mainstream. More corporations are doing exactly what Strategy did, using Bitcoin as a treasury reserve. That takes a massive chunk of supply off the market, supply that won't come back easily. So what should you do right now? Watch the on-chain data. Are coins from 5+ year wallets still moving? Or has selling slowed? Track ETF inflows. Rising numbers mean institutions are still hungry. Watch macro headlines. Interest rate cuts or liquidity injections can light the fire for risk assets. Most importantly, plan your entries. Accumulation phases are slow, but they don't last forever. Decide how much Bitcoin you want to hold before the breakout and stick to your plan.